What's the best way to gather information on a stock that you're going to invest in? If you want to know the answer, make sure to watch this video until the end. Hello future billionaires, welcome to Stock Investing 101, the channel where you get stock inspiration, motivation and knowledge to become the next future billionaire. In today's video, we will be looking at everything you need to know about the stock market before you start investing. Before we finally begin to talk about some major stuff here, you need to curb your ego. The only thing you should know is to make sure that you make investments based on real logic rather than emotional investments when you invest, particularly if you are starting to invest. Try to locate a friend who might also learn about investing, or maybe they've been investing for a long time already. Call them, speak to them, and kind of use this buddy method. You call one of your friends or colleagues and tell them about this investment you are thinking of before making any investment. Run it over with them and see what some of their concerns they have about it, and you can bounce ideas off of each other. What are investment strategies? An investment strategy drives an investor's decision based on priorities, risk tolerance, and potential capital needs. Where an investor focuses on capital appreciation, some investment strategies pursue rapid growth, or they may adopt a low-risk approach where healthy security is the priority. What is a stock? Stocks are shares in a company that reflect an ownership share. For businesses, stock issuance is a way to raise capital to expand and invest in their company. Stocks are a way for investors to raise their capital and outpace inflation over time. How to buy stocks? The best way to purchase stocks is from an online stockbroker. In a matter of minutes, you can buy stocks via the broker's website after opening and financing your account. Other choices include using a full-service stockbroker or directly purchasing stock from the company. Once you have set up your brokerage account and funded it, it's time to dive into the stock-picking market. A good place to start is by researching business you already know as a consumer from your experiences. As you perform your analysis, don't let the deluge of data and real-time market gyrations overwhelm you. Keep the target simple. You're searching for businesses that you want to be part owner of. To buy several shares or fill your entire portfolio with stock all at once, you should feel absolutely no pressure. Consider starting small, minimal, buying only a single share to get a sense of what it is like to own individual stocks and whether you have the stamina to travel with minimal sleep loss through the rough patches. As you master the shareholder swagger, you can add to your role over time. What are the types of brokerage accounts? A cash account is a form of investment account in which, for securities purchased, the investor must pay the full amount. You're not permitted to borrow funds from your broker in a cash account to pay for purchases in the account. A margin account is a form of brokerage account in which, with the securities in your portfolio acting as collateral for the loan, your brokerage firm will lend you money to buy securities. You can incur interest costs when you purchase securities on margin, as with any other loan. Passive versus acting investing. Active investing takes a hands-on approach and needs someone to act in the role of a portfolio manager. Active money management aims to beat the stock market's average returns and take full advantage of short-term price fluctuations. You save for the long term if you're a passive investor. Inside their portfolios, passive investors restrict purchasing and selling, making this a very cost-effective way to invest. A buy and hold mindset is needed in the strategy. That means resisting the urge to respond or predict the next step in the stock market. Dollar cost averaging. To minimize the effect of uncertainty on the overall purchase, the dollar cost average, or DCA, is an investment strategy in which an investor splits up the total amount invested by periodic purchases of a target asset. The transactions occur irrespective of the price of the asset and at regular intervals. In effect, this method eliminates much of the detailed work of trying to time the market to make equity purchases at the best rates. The constant dollar strategy is also known as the dollar cost average. Mutual funds, ETFs, index funds. The stock market is a one-person show where it is important to make all the decisions. However, the mutual fund is teamwork because it raises money from a mutual fund from individuals like us. $500 from me and $500 from you, and a money pool is formed. A fund manager then uses this pool to invest in stocks, bonds, and other assets. An ETF, much like a mutual fund, holds different individual assets bundled together. The difference is that ETFs trade during the day like a portfolio and are purchased for a share price. An ETF share price is often lower than the minimum investment requirement of a mutual fund, making it a good option for small or new investors. An index fund is a type of mutual fund or exchange-traded fund, ETF, with a portfolio designed to match or track the components of an index of the financial market, such as the Standard & Poor's 500 Index or S&P 500. It's said that the index mutual fund offers wide market exposure, low operating expenses, and low turnover in the portfolio. Stock research. There are two real strategies for looking at businesses. Qualitative analysis, so this is more along the lines of looking at the culture of a company, looking at the business model, looking at its vision, and even a company's leadership. The quantitative approach focuses far more on looking at the actual hard facts and the statistics. Where to gather information. There are a few ways that you can do this. One is through the brokerage company you have. So whether you're using Vanguard or using Fidelity, a lot of these businesses have their own research channels inside each of these brokerage firms that you can sign up for. So if you want to buy any stocks or look at their earning reports, then through one of the brokerage firms you have through your account, you can do much of that. It ought to be very straightforward. Form 10K and 10Q. This is going to be an annual report from them, looking at the past year, talking about last year's figures, and then talking about their future predictions. So, for starters, they laid out what they expect would happen in 2021. Typically, we will see this happening right around the turn of the calendar year, although some businesses might rely on it. So, download the 10K form. For most firms, this would probably be roughly around 100 pages. They want individuals to invest in their business. This is their annual report to their investors that goes out, but they're going to try and spin it in a really positive light, so make sure you do all your due diligence there and do all that with extensive analysis. There will also be stuff called 210Qs now, which will basically be just an update every quarter on what they are thinking about for the next quarter, based on looking back on their 10K. 10K is the best place to get a company's information. Just from those, you'll learn a lot. Bull versus bear markets. If you're in a bull run, it means that it's going up. You believe that it's going up. Bearish on the market or in a bear market will be when the markets are going down. They're in a slump, so that is just some terminology. Dividends. As decided by the company's council of directors, a dividend allocates some of the company's profits to a class of its shareholders. Common owners in dividend-paying firms are usually entitled as long as they own the stock before the ex-dividend rate. The dividend can be paid out as cash or in the form of additional stock. How much should you invest? It's alright if you lose any money just to begin with, but it's important to start with a small amount of money. Start with a small amount of cash in the stock market and then build it up over a long time, because reading books is one of the best ways to learn, but your mistakes are the other best ways to learn. People make mistakes, and it's scarce to see anyone leap into the stock market and crush it entirely. People slip at some point. They have a deficit of judgment. Within a company, they don't see one thing they should have realized, and they suddenly end up losing a lot of money. Pro tip, start with a little money, something that you can afford to lose. So if you're living paycheck to paycheck and don't have any money at all, then maybe start with $50 or $100 in the stock market. And then you can start adding more money to it over months or years. If you'd like to stay up to date with the best and latest content about stocks and entrepreneurship, then make sure to subscribe to our channel and leave a like on this video. Did you find this video valuable, or do you want to add anything? Make sure to let us know in the comments section down below. We're posting a new video every day with the most undervalued stocks in the market right now.